Mike Shedlock, better known as Mish, joins us today. He is an economic writer, and we're talking about all things gold, U.S. dollar, and monetary policy. Mish, welcome to the show.
Pleasure to be on Kitco.
Pleasure to have you. Mish, let's start by talking about recent gold price movement. As we're speaking today, gold has risen and the U.S. dollar has weakened. Now, looking a little bit more long-term, the last couple of months has seen consistent gold price weakness as well as U.S. dollar weakness. Usually they move in opposite directions. Can you explain why they've been moving consistently downwards together for the last couple of weeks?
Well, it's a common fallacy, actually, that gold's moves are predominantly related to the U.S. dollar. I've posted long-term charts of the U.S. dollar index, and you can find gold at 1,200, at 1,600, at close to 2,000, all at the same points with the U.S. dollar index. Now, it's true that in the very short term, normally when gold moves up, the dollar goes down, but you can find years. I think 2005 was one of them where there are these relationships that are positively correlated. So the whole notion that gold moves or is predominated by moves in the dollar is false, and the long-term charts prove that. It's really more about sentiment.
How did this misconception come about then, if you're saying that this is not really a predominant indicator?
This is just what mainstream media writes about. You even see it on places like the Wall Street Journal, of all places, where they talk about jewelry demand, demand for gold in India, demand by central banks. None of that matters, nor does production matter. Every ounce of gold ever mined constitutes part of the supply. Similarly, you can make the same claim about Bitcoin. The supply of Bitcoin is not these marginal increases in mining. The supply of Bitcoin is every Bitcoin ever mined. So when people talk about production and jewelry demand, they miss the overall supply. Someone has to hold every ounce of gold ever mined and every Bitcoin ever mined. And they have to make these trade-offs constantly. Do I want to hold gold? Would I rather have other assets? That's the way one needs to think about this. And in a certain sense, one needs to think, do I want to hold gold or dollars? But it's always gold versus something else. And people misconstrue the true supply of gold.
So if the jewelry demand isn't an important indicator of gold price and the dollar doesn't matter, what does matter, Mish? What are you looking at when you're determining where gold prices are going?
It's hard to put numeric values on this, but ultimately gold is a reflection on faith in central banks. Is everything under control? If you go back to when gold first shot up to $850 after Nixon removed the ties of gold to foreign currency exchanges, the dollar was no longer redeemable for gold. Confidence in the dollar shrank. Faith in gold soared. $850 from $35 an ounce, essentially, in a matter of a few years. Then what happened? Volcker came in, raised interest rates, all the way to 20%, resumed faith that central banks had things under control. Then Greenspan came in. He had a long period of Greenspan where the media, the public, everyone believed that Greenspan was this great maestro. That's how he was labeled. And we had a period of disinflation. That's when gold generally does worse. So we had falling rates of inflation, rising confidence in the Greenspan Fed that everything was under control, a very, very poor time to own gold. We had inflation every step of the way. So gold's not a measure of inflation. It fell from 850 to 250 with inflation every step of the way, but it was disinflation and confidence in the Fed, confidence in the dollar, confidence that things were under control.
Do you have confidence now that the central banks have everything under control?
I think you know the answer to that. But you know, that's another thing that explains the recent action in gold here is, Janet Yellen is appointed to the Treasury. For whatever reason, people like Yellen, have faith in Yellen. I certainly don't, but the market does. So I don't get to make the call, and you don't get to make the call. But I think that's one of the reasons for this. We had faith in Yellen and faith that things wouldn't get out of control. And just look at the election. So it's not just faith in central banks, but it's also faith in governments. And I've not really mentioned that before, but it's true. If we look at the expectation coming into the November election, it was that Biden would win. At least I believe that. That's what the market believed, and ultimately that was correct. But there was also an expectation that the Democrats would pick up seats in the House and win the Senate. Guess what happens if all those things happen? Who knows what kind of crazy policies we're going to see from Warren, from AOC, from all the progressives in Congress. Biden claims to be a centrist, but he's got all of this pressure, constant pressure from the progressives, from the ultra left to do all these things and to even bail out states. So we had all of that lend a rise in the support for gold. Well, then what happens? The election comes around. Guess what? The Democrats didn't win the Senate. We're wondering whether or not that they're going to get much of any of their progressive agenda passed in the Senate. Guess what? That puts a little bit more faith back in the fiscal responsibility of the U.S. We all knew, everyone knew, that deficits were going to go out of the moon no matter who won, but it's a matter of degree. We were pricing, gold was pricing in at 2000 this progressive agenda that didn't happen. Now all of a sudden we've got Yellen and we've got a fiscal stalemate in Congress, and that's the message.
One of the more left-wing, I guess, policies would be modern monetary theory. Well, it's an unofficial policy, but they do support more stimulus, a lot more money printing. And do you see that having any impact? Look at this chart that you showed me earlier. So it shows money supply versus the price of gold. I get this all the time from analysts and economists saying that yes, a larger expansion of the money supply is positive for gold. But look at periods in the past, particularly in, let's say, 2011, 2012, 2013, when we had the taper tantrum, and then they receded their balance sheet for a bit. Gold continued to climb during that period when the balance sheet shrunk. So is there really a strong relationship between money supply and gold?
Not really, and that's what the chart shows. I mean, you look at these charts and people say, well, it's about jewelry. It's about money supply. It's not. It's about confidence in the Fed. And we look at the last high when gold was surging to 1900. Europe was in a crisis. There was risk that the European Union was going to break up. Interesting thing, Mario Draghi, the president of the ECB, the European Central Bank, comes out and said, we will do whatever it takes to save the euro. And believe me, it'll be enough. I don't know if people know the end of that story, but what did Draghi actually do? The answer is nothing. All he did was make that statement. They didn't go into QE. They didn't have negative interest rates. He didn't push anything from the fiscal end. He made a statement. That statement restored faith in the ECB. So, and then over time, that faith starts to erode. The ECB, like the Fed, promised all of these kinds of things. They haven't delivered. The only thing they consistently deliver on is reducing interest rates in a time of panic and more QE. It's all lopsided. I think that was the driving force here when starting around 2015, people started questioning, does the Fed really have everything under control? And we see all these repro panics and all of these other panics, and the Fed announcing they're going to do all these rate hikes. I'm wondering who believed these rate hikes. I didn't, but the market did for a while.
Well, doesn't the ECB have, the Eurozone, they have negative real interest rates now, don't they? I mean, you said they didn't before, but they do now.
Yeah, and this is how everything ties together. Most of the world is, or at least, most of the U.S. is too U.S. centric. We look at all of these things. We look at exploding deficits. We look at this. We look at that. How can the dollar possibly be as strong as it was? And people were confounded by the fact that the U.S. dollar index got back above 100. Why? Well, we had positive interest rates here in the United States. So people need to look at what's happening, not just with U.S. with deficits, but with things that are happening on a global basis. You have negative interest rates in Japan, negative interest rates in the euro. Guess what? People look at that and say, you know what? I'll put my money in the U.S. stock market. I'll put my money in U.S. dollars. I'll put my money where at least I have a positive return rather than a negative return. So those are the things that, that balance out, the problems with the deficits, the balance of trade, and other things. Oh, it's not just one thing. It's this basket of things that causes these sentiment changes to fluctuate. But meanwhile, sentiment, faith in banks is walking itself down slowly over time. That's the message here of gold, I believe.
If you look at the chart again for showing gold versus the money supply, another argument I've heard is that the money supply, as it expands, will cause inflation, and that will be driving gold in the long term, medium to long term. Now, I wonder, Mish, has inflation really been rearing its head in the last decade? Have we had a lot of inflation since the great financial crisis of 2008?
This gets to the question of how does one define inflation? The Merriam-Webster definition in 1957 was defined inflation as an increase in money supply, and perhaps it was increase in money supply and credit. That definition is almost perfect. The central banks and various governments, attacked. And the mainstream media picked up on it, the definition. Now the definition is some sort of basket of goods as measured by the CPI. I'm sorry, that's just not inflation. So, but if you're looking at the prices of goods, of a loaf of bread or of chicken, and I've done charts on chicken, it's really kind of fascinating. I used to work in a grocery store in 1968. The price of chickens, whole chickens on sale back then were 20 cents a pound, a loss leader. You can find them now on sale for 60 cents a pound. We're talking, how many years since 1968 to now? If you measure that out, it's about 1.5% a year or something on the price of a chicken on sale. But, so people look at that and call that inflation. But what about the stock market? What about the bond market? What about the price of houses? The price of education? Any place where government interfered, prices have soared. You got all these affordable housing programs. Yet housing is not directly in the CPI. It used to be. If you go back to the mid 60s, housing was directly in the CPI. If we put housing back in the CPI now and removed owner's equivalent rent and put back in actual home prices, you would see that inflation is running about 6% or so off the top of my head. I'm gonna produce these charts. I've done it before. I've not looked at it recently. So this notion that there's no inflation counts on you not looking at where inflation is in inflated asset prices, especially home prices, because those are actually directly measurable by the Case-Shiller home price index.
Okay, so you think we're in a housing bubble, Mish, right now? Why hasn't it popped
I
already?
think we're back in a housing bubble. Perhaps I should send you some charts on this as well. The Case-Shiller home price index in something like 17 out of the top 20 cities in the U.S. is back above the previous bubble high. And we will say, well, this is all supported because interest rates are low, but interest rates are low is just one of the factors that is causing asset bubbles in the first place. So people can always find a way to justify these bubbles. They did it in 2006 and 7, and they're doing it again now. And meanwhile, the Fed, under Yellen, under Bernanke, now Powell, is all worried about income inequality. What's the big source of income inequality? What's the big source of these massive inequalities? And it's the price of assets. The ownership class owns them. The CEOs own stocks. The top 10 or 20% own. Actually, the top 5% owns a monstrous portion of the assets. They rail about all these Fed governors and presidents, and the ECB rail against inequality. They're the source of it by creating these financial bubbles. The bottom 10% that owns no assets, the bottom 40% actually that have hardly any assets, don't benefit from these bubbles. It's the wealthy. It's the people who have first access to money, governments, banks, and the wealthy, that these central bank policies favor. Yet they sit back and they rail against income and wealth inequality when they are the sole driver of it all.
Mish, let's tie this back to the gold price now, and this will be my final question to you. Where can we see gold back at $2,000 again?
Oh, I think that's a certainty. The question is what time frame. I'm asked this question all the time, and I've never answered it actually. It's because I don't know. Looking back, so many people were even wrong about this election and what it would mean. You had on one side people believing that Trump was going to win again, and you had most of the Democrats believing that they were going to take over control of everything, and neither of those things happened. A lot of people did not foresee negative interest rates coming out of the ECB. I have people going back to 2005, 2007, even just 5 years ago, saying the ECB would never do this. Well, the ECB did do that. Now the question is, how do they get out of it? So all we can say for sure with certainty is that central banks are going to keep debasing currencies over time. Have negative interest rates in China for the first time ever. Negative interest rates in Portugal for the first time ever. So it's all of these counterbalancing forces. And again, it's important to look outside of the U.S. to events that are happening in China, in Europe, not just being so U.S. dollar focused. And I laugh at all of the people predicting hyperinflation here in the U.S. It can't happen as long as we've got global currency debasement going across the globe. In some instances, in some ways, at some times, the U.S. is doing better than these negative interest rate policies that we see in Europe and Japan. So those are the kind of things we look for. We look for changes in sentiment. We had one today. I think that explains the rise in gold today, where people were all of a sudden starting to believe that there would be no fiscal stimulus here in the United States, going from one huge extreme of this progressive agenda to now total gridlock with the deficit not even going up. It's swung back today in the right direction. People are again looking at the deficits in the U.S. going up as far as the eye can see. We balance that against what's happening in the rest of the world, and we see, okay, it's likely that the price of gold is going to keep rising. I don't have a price, sorry.
And that's no problem, Mish. I enjoyed speaking with you today. Thank you for coming on the show, and I look forward to following up with you. Thank you.
It's a pleasure to be on Kitco. Look forward to coming back. I think it was a great discussion. Thanks for having me on.
Thank you for watching. I'm David Lynn.